What if the company that's supposed to have your back stabbed you in it instead? Millions of customers, billions in premiums. And yet, one shocking investigation reveals how State Farm, one of America's most trusted car insurance giants, might have scammed drivers out of what they were owed. From denied claims to hidden policies, whistleblowers are speaking out, and what they're saying could change the way you see car insurance forever. Is this just one big misunderstanding, or is State Farm hiding something far worse? Stay tuned, because what you're about to see could make you think twice before renewing your policy. For decades, State Farm has been synonymous with trust, security, and the comforting promise of being there when you need them most. Their iconic slogan, like a good neighbor, State Farm is there, has been drilled into the American psyche through relentless advertising, heartwarming commercials, and even catchy jingles that make policyholders feel safe. As the largest auto insurer in the United States, State Farm has built an empire on the perception of dependability, covering 1 out of every 5 cars on the road. But behind a friendly green logo and reassuring agents, a far darker reality lurks. Whispers of deceit, fraud, and systemic betrayal have haunted the company for years, buried beneath layers of legal settlements, nondisclosure agreements, and carefully crafted PR spin. Former employees, whistleblowers, and investigative journalists have slowly peeled back the veneer, revealing a corporation that may have prioritized profits over people, repeatedly. What if the good neighbor was never really there when disaster struck? What if, instead of honoring claims, State Farm engaged in deliberate schemes to delay, deny, and underpay its own customers? The truth is more unsettling than most policyholders realize. From manipulating engineering reports after Hurricane Katrina to allegedly bribing judges and using secret algorithms to slash payouts, State Farm's history is riddled with scandals that suggest a pattern of calculated deception. And while the company has paid millions in fines and settlements, the real question remains, was this just the cost of doing business, or proof that the system is rigged against the very people State Farm claims to protect? As we delve deeper into the evidence, one thing becomes chillingly clear. The most dangerous risks policyholders face may not be on the road at all, but in the fine print of their insurance contracts, where State Farm's promises may not be what they seem. Behind every corporate scandal, there's usually one courageous individual who risks everything to expose the truth. In State Farm's case, that person was Carrie Rigsby, a former claims adjuster who blew the whistle on one of the insurance industry's most shocking fraud schemes. What she revealed wasn't just corporate negligence. It was a calculated, systemic effort to cheat policyholders out of billions. The bombshell revelation. Rigsby, along with her sister and co-worker Corey Rigsby, worked as catastrophe claims adjusters for State Farm in the aftermath of Hurricane Katrina in 2005. What they witnessed wasn't just bureaucratic inefficiency, it was outright fraud. According to sworn testimony and leaked internal documents, State Farm deliberately altered engineering reports to deny legitimate wind damage claims by falsely attributing destruction to flooding, which wasn't covered under most policies. Employees were allegedly pressured by superiors to change reports, sometimes even forging signatures of engineers who had initially ruled in favor of homeowners. In one explosive case, an engineer's findings were allegedly whited out and rewritten to shift blame from wind covered to water not covered. The motive? Save State Farm hundreds of millions in payouts while victims of Katrina struggled to rebuild their lives. The legal battle, silencing the truth? When the Rigsby sisters went public, they didn't just lose their jobs, they became targets. State Farm sued them, claiming they violated confidentiality agreements. But the sisters countersued under the False Claims Act, accusing the company of defrauding the federal government, since many claims were tied to federal flood insurance. The case exploded into a national scandal, with evidence showing State Farm had systematically denied claims in bad faith. Yet, despite damning proof, the legal battle dragged on for years. In the end, State Farm settled for $250 million, but admitted no wrongdoing. Worse, many Katrina victims never saw a dime of that money, while the Rigsbys faced career blacklisting and relentless legal harassment. The bigger cover-up. The most chilling part? The Katrina fraud wasn't an isolated incident. Insiders later revealed that State Farm had used similar tactics in other disasters, from hurricanes to wildfires. A former employee anonymously confessed, "They trained us to find reasons to deny claims. If a policyholder didn't fight back hard enough, they got nothing." The lingering question, how many were betrayed? State Farm still denies any systemic fraud, but the evidence suggests otherwise. If they were willing to manipulate reports, forge documents, and retaliate against whistleblowers after one of America's worst natural disasters, what else have they gotten away with? When Hurricane Katrina's catastrophic winds and floodwaters ravaged the Gulf Coast in 2005, thousands of desperate homeowners turned to their insurance policies, many with State Farm, as a lifeline to rebuild. But instead of honoring its promises, State Farm engaged in what federal investigators later called one of the largest acts of insurance bad faith in U.S. history. Behind closed doors, the company orchestrated a ruthless scheme to systematically deny, delay, and underpay claims, exploiting fine print and manipulating reports to avoid paying billions in rightful settlements. The engineering report fraud. The most damning evidence emerged from State Farm's own internal documents. Engineers hired to assess storm damage had initially confirmed that wind, a covered peril, destroyed homes before floodwaters ever arrived. But according to whistleblowers and court filings, State Farm pressured these engineers to alter their findings, sometimes even white-outing original conclusions and replacing them with fraudulent statements blaming flooding instead. In some cases, engineers who refused to comply were blacklisted from future work, while those who played along were rewarded. One explosive case involved the McClellan family of Mississippi, whose home was reduced to rubble by Katrina's 140 miles per hour winds, only for State Farm to deny their claim by insisting it was flood damage. When the McClellans sued, internal emails revealed State Farm supervisors directly ordered adjusters to reevaluate wind damage claims to shift blame to water. A jury later awarded the family $2.5 million in punitive damages, calling State Farm's actions reckless and malicious. The rewriting history strategy. State Farm didn't just deny claims, it retroactively altered policies. Homeowners with long-standing all-risk policies suddenly found themselves facing new, restrictive language after the storm. In some cases, adjusters were allegedly instructed to backdate policy changes to exclude flood-related damage, leaving victims with no recourse. The government's role, a silent partner? Even more alarming, State Farm's scheme extended to taxpayer-funded programs. The company served as a key administrator for the National Flood Insurance Program, NFIP, processing federal flood claims while simultaneously denying its own wind coverage. Investigators found that State Farm routed payouts through NFIP whenever possible, effectively offloading its liabilities onto the U.S. government. The $250 million slap on the wrist after years of litigation. State Farm agreed to a $250 million settlement with the U.S. Department of Justice, but admitted no guilt. For a company that reported $5.6 billion in profits that year, the penalty was a drop in the bucket. Most shocking of all, fewer than 10% of affected policyholders ever saw compensation, and many are still fighting today. The unanswered question. Katrina exposed State Farm's playbook. Disasters equal profit opportunities. If they could exploit a national tragedy on this scale, what else have they done in smaller, quieter cases where no one was watching? For years, State Farm policyholders who filed injury claims after car accidents noticed something disturbing. No matter how severe their medical bills or documented suffering, the insurer's settlement offers were suspiciously and consistently low. What victims didn't know was that State Farm wasn't just lowballing them. It was outsourcing its decisions to Colossus, a shadowy claims adjustment software designed to systematically minimize payouts regardless of individual circumstances. How Colossus worked. The invisible hand slashing settlements. Developed by the Australian firm Computer Sciences Corporation, CSC, Colossus was marketed to insurers as a way to standardize claims evaluations. But internal documents and whistleblower testimonies revealed its true purpose: to algorithmically cap payouts while creating the illusion of objectivity. The range manipulation. Instead of assessing each injury claim individually, Colossus generated preset compensation ranges based on historical data that State Farm itself supplied. By feeding the system artificially low past settlements, the insurer ensured future payouts would stay depressed. The severity score scam. Claims adjusters were required to input injury details into Colossus, but the software frequently overrode their judgments. Even for catastrophic injuries, e.g., herniated discs, traumatic brain injuries, the system would flag payouts as out of range if they exceeded State Farm's profit targets. The red flag trick. Colossus was programmed to aggressively challenge certain claims triggers, like chiropractic care or subjective pain reports, automatically labeling them suspicious to justify denials. The human cost. I was told the computer said no in sworn depositions. Former State Farm employees admitted they were forbidden from deviating from Colossus outputs, even when they knew the amounts were unjust. One adjuster testified, "We'd have cases where someone clearly needed surgery, but Colossus would spit out $3,500. If we tried to override it, managers would shut us down." Victims like Linda Sanchez, a teacher left with permanent nerve damage after a rear-end collision, described fighting for 2 years while State Farm cited system calculations to offer just 20% of her medical costs. "It felt like arguing with a robot," she said. The legal reckoning, too little, too late. By the early 2000s, lawsuits exposed State Farm's manipulation of Colossus. 2003, New Mexico, a judge ruled State Farm acted in bad faith by using the software to underpay a car crash victim, ordering $145 million in punitive damages, later reduced. 2007, Canada. A leaked memo showed State Farm's Canadian branch trained adjusters to input data selectively to skew Colossus outputs lower. Yet despite these cases, State Farm continued using Colossus for years, simply tweaking its inputs to avoid detection. The insurer never admitted wrongdoing, and most policyholders never knew an algorithm was gutting their claims. The chilling legacy. Colossus wasn't just a tool. It was a weaponization of big data against vulnerable accident victims. Worse, its tactics became an industry standard. Allstate, Geico, and Progressive later adopted similar systems. The burning question, how many thousands of injured drivers were cheated while State Farm's profits soared? And how many are still being cheated today by algorithms they'll never see? State Farm, one of the largest and most well-established insurance companies in the United States, has long been a household name. Known for its comprehensive range of insurance services, including auto, home, and life insurance, the company has enjoyed a solid reputation in the industry. However, like many large corporations, it has also faced legal controversies and allegations of misconduct over the years. While State Farm has often been involved in lawsuits related to standard business disputes, one of the more significant and eye-catching legal issues it faced was connected to allegations of bribery and corruption. This case highlights a critical issue in the insurance industry: the potential for unethical practices in a sector where large sums of money are at stake and where relationships with politicians, regulators, and even law enforcement may cross into murky territory. The background: State Farm's rise and dominance. Founded in 1922 by George J. Metchley, State Farm quickly grew from a small auto insurance company into a nationwide powerhouse. By the mid-20th century, State Farm had solidified its place as one of the leading insurers in the country. The company is currently based in Bloomington, Illinois, and serves millions of customers across the U.S. While its rise to success was largely due to its focus on customer service and affordable rates, the size and influence of such a corporation naturally made it a target for scrutiny, especially in regard to its business practices. The allegations of bribery and corruption. The bribery and corruption allegations against State Farm emerged during a time when the company was under intense public and regulatory pressure. The incident that sparked these allegations involved the company's dealings with lawmakers, regulators, and other influential figures to influence the way insurance policies were regulated and to secure favorable treatment for State Farm. The role of political contributions and lobbying. State Farm, like many large corporations, engaged heavily in lobbying to influence the regulatory landscape of the insurance industry. Lobbying is a common practice among large corporations, but it can sometimes lead to unethical behavior, especially when it involves making political contributions that are aimed at securing favorable regulatory treatment or influencing policy decisions. In this case, State Farm was accused of making substantial political contributions to state and federal lawmakers in exchange for favorable insurance laws and policies. It is alleged that these contributions were used as a form of bribery, influencing officials to pass legislation that benefited State Farm, often at the expense of competitors or the public interest. The issue came to light during an investigation into the company's political activities, which included donations and the funding of political action committees that supported candidates sympathetic to the insurance industry. Alleged corruption in insurance regulation. Another layer to the bribery and corruption case involved allegations of improper relationships between State Farm executives and regulators. The company was accused of engaging in a pattern of corrupt behavior to influence insurance regulation in its favor. Specifically, State Farm allegedly offered perks and benefits to insurance regulators in exchange for leniency on regulatory actions, such as reducing fines or allowing rate hikes without proper oversight. In some cases, regulators were accused of accepting gifts, trips, or other forms of compensation from State Farm in exchange for favorable treatment. These alleged exchanges have been described as a form of quid pro quo, where regulators were effectively bought to ensure that the company faced fewer consequences for potential violations of state and federal insurance laws. The role of State Farm employees in the alleged scandal. Beyond State Farm's dealings with politicians and regulators, there were also allegations that employees within the company engaged in corrupt practices. Whistleblowers came forward to claim that State Farm employees had engaged in fraudulent activities, such as falsifying claims, making unauthorized payments, or offering bribes to third parties to secure claims payments. The case also involved accusations of employees being involved in a broader scheme to manipulate the claims process in order to favor certain clients or to avoid payouts. Such practices could be seen as part of a larger corporate culture that prioritizes profit over ethical behavior, leading to serious legal and reputational risks for the company. The investigation and legal proceedings. The investigation into the bribery and corruption case involving State Farm was complex and involved several state and federal agencies. Federal prosecutors, state attorneys general, and insurance regulators worked together to probe the company's practices, which spanned several years. One of the major breakthroughs came when former employees and industry insiders provided critical testimony, helping to connect the dots between State Farm's political contributions, the alleged corrupt relationships with regulators, and the fraudulent activities inside the company. This was crucial for building a case that would stand up in court. Despite the mounting evidence, State Farm vehemently denied the allegations of bribery and corruption. The company maintained that its political contributions and lobbying efforts were legal and within the bounds of the law. Furthermore, State Farm claimed that it had strict internal controls in place to prevent corruption and that any wrongdoing within the company was the result of rogue employees acting independently. However, the damage to State Farm's reputation was already done. As the case gained public attention, State Farm found itself at the center of a media firestorm. The company faced intense scrutiny, and its stock price fluctuated as investors reacted to the news. Legal experts began to speculate about the potential penalties State Farm could face if the case resulted in a conviction. The outcome: penalties and reforms. After years of legal battles and a series of settlements, State Farm ultimately agreed to pay substantial fines and restructure its operations to avoid further scrutiny. While the company did not admit to any criminal wrongdoing, it acknowledged that its practices had fallen short in some areas, and it implemented a range of reforms aimed at improving its internal controls and compliance procedures. Some of the key outcomes of the case included fines and settlements. State Farm agreed to pay millions of dollars in fines and settlements to resolve the various legal claims. While the financial penalties were significant, they did not cripple the company, as it remained one of the largest insurance companies in the U.S. Changes to political contributions and lobbying. As part of the settlement, State Farm agreed to adopt stricter guidelines on political contributions and lobbying activities. This included limiting the amount of money it could contribute to political candidates and increasing transparency in its lobbying efforts. Internal reforms. The company also took steps to improve its internal compliance programs. This included training employees on ethical behavior, enhancing oversight of claims handling and regulatory interactions, and improving the reporting mechanisms for potential misconduct. Public relations efforts. To rebuild its reputation, State Farm launched a public relations campaign aimed at restoring customer trust. The company emphasized its commitment to ethical business practices and pledged to cooperate fully with regulators to ensure that it operated in compliance with the law. Long-term implications for the insurance industry. The State Farm bribery and corruption case had significant implications for the broader insurance industry. It underscored the need for stricter regulations and oversight in an industry that, by nature, involves large financial transactions and complex interactions with regulators and politicians. One of the lasting impacts of the case was a heightened awareness of the potential for corruption in the insurance sector. Regulators at the state and federal levels began to implement more stringent rules and oversight procedures to prevent similar scandals from occurring in the future. Additionally, the case prompted other companies in the industry to reevaluate their own lobbying and political contribution practices to ensure that they were operating within the boundaries of the law. When your car breaks down, it can be a stressful and expensive experience. Most drivers rely on auto repair shops to get their vehicles back on the road, trusting the expertise of mechanics to fix their cars safely and efficiently. Unfortunately, not all auto repair businesses operate with integrity. One of the most insidious forms of fraud in the auto repair industry is the use of cheap, substandard parts. While the price tag might look attractive, these inferior parts can lead to big risks for both car owners and their vehicles. This type of auto repair fraud, involving the use of low-quality or counterfeit parts, is a growing concern that can have serious consequences. In this article, we'll explore how auto repair fraud works, the dangers it presents, and how consumers can protect themselves from falling victim to this type of fraud. What is auto repair fraud involving cheap parts? Auto repair fraud can take many forms, but one of the most common scams involves the replacement of genuine, high-quality parts with cheap, substandard, or counterfeit alternatives. These frauds can occur in various ways. Substandard parts. Some mechanics may knowingly install low-quality or cheaper parts that are not as durable, effective, or safe as the original manufacturer's parts. The goal is to increase their profit margins by using parts that cost less while charging the customer the price for original, high-quality parts. Counterfeit parts. Counterfeit parts are imitations that are made to look like genuine parts from trusted manufacturers but are often constructed with inferior materials. These parts may not meet safety or performance standards, and their use can pose significant risks to the vehicle's safety and longevity. Unnecessary repairs. In some cases, mechanics may falsely claim that certain parts need to be replaced or repaired when they do not. The mechanic may install cheap parts to replace perfectly functional ones, charging the customer for parts and labor they didn't need. Overcharging for repairs. This often goes hand in hand with the use of substandard parts. A repair shop might charge for premium parts or repairs, but install cheaper, lower quality components without the customer's knowledge. The customer is paying for a high-end fix, but receiving a much lower quality solution. Why do mechanics use cheap parts? The motivation behind using cheap or counterfeit parts in auto repairs is often financial. Here are some reasons why a mechanic might choose to use inferior parts. Profit margins. Cheap parts are significantly less expensive for repair shops to acquire than high-quality or genuine manufacturer parts. By using cheap or counterfeit components, a mechanic can keep their overhead costs low while charging customers a higher rate for repairs. Customer perception of value. Some repair shops market themselves as offering affordable or budget-friendly repairs. To maintain this image, they may use cheaper parts, believing that customers are more likely to return for repairs if they believe they're saving money. However, this can backfire if the substandard parts lead to more breakdowns or safety issues.